Something major changed in the tax system today. And if you're a senior or retiree, this one quiet change could decide whether thousands of your dollars stay in your pocket or disappear to the IRS without you even realizing it. Most people won't hear about it on the news. Most tax preparers won't bring it up unless you ask. And by the time many retirees discover it, the money will already be gone. This isn't speculation. This isn't a rumor. This is a brand new IRS filing rule that just took effect, and it directly affects Americans age 65 and older. If you rely on Social Security, retirement accounts, a pension, or even part-time income, what you're about to hear matters more than almost any tax rule you've dealt with in years. Because this change isn't small, it isn't symbolic, and it isn't permanent. In fact, it comes with a hard clock attached to it. And once that clock runs out, the opportunity disappears. The reason this is urgent is simple. If you don't understand this rule now, you can't plan around it. You can't protect yourself from overpaying, and you could end up giving the federal government money it no longer requires you to pay. By the end of this video, you'll know exactly what changed, who qualifies, and why waiting or assuming someone else will handle it could cost you far more than you expect. Here's the part almost nobody is clearly explaining. A new IRS rule has officially taken effect that allows seniors age 65 and older to claim an additional tax deduction on their federal return on top of everything they already receive. If you're single and qualify, that deduction is $6,000. If you're married and both spouses qualify, it's $12,000. This is not a credit. This is not a temporary adjustment buried in fine print. This is a direct reduction of your taxable income. Real dollars that no longer get touched by federal income tax. And unlike many tax changes that only help one narrow group or require complicated maneuvers, this one applies broadly to seniors who fall within specific income limits. What makes this so significant is that this deduction stacks on top of the standard deduction and the existing age-based deduction that seniors already receive. In plain terms, that means tens of thousands of dollars of retirement income can now be shielded from federal taxes if you qualify and claim it correctly. But here's where urgency really comes in. This deduction is temporary. It only applies for a 4-year window from 2025 through 2028. After that, unless Congress extends it, it disappears entirely. No grandfathering, no retroactive claims, no second chances. That means every decision you make about income, withdrawals, and timing during these 4 years carries more weight than it used to. This is not something you can afford to figure out later. And there is a catch, not a trick, but a rule most people misunderstand. This deduction begins to phase out once your income crosses certain thresholds. For single filers, that line starts at $75,000. For married couples filing jointly, it starts at $150,000. Above those levels, the benefit shrinks, and eventually it disappears, which means planning matters, timing matters, and assumptions can be expensive. What's especially important to understand is that this deduction isn't designed to reward aggressive tax strategies or complicated loopholes. It was created to provide real relief to seniors facing rising costs, inflation, healthcare expenses, and shrinking purchasing power in retirement. But the IRS will not automatically give this to you just because you're eligible. If you don't know it exists, if you don't claim it correctly, or if you structure your income without understanding how this rule works, the benefit doesn't apply. And that's why so many retirees are at risk of missing it. Not because they did anything wrong, but because nobody clearly explained what just changed and why it matters right now. Before we go any further, let me quickly introduce myself so you know exactly why I'm walking you through this and why the details matter. Hi, my name is Susan Harper, and I focus on breaking down complicated financial and government rules into plain, practical language, especially the kinds of rules that quietly affect retirees and seniors the most. No hype, No scare tactics, no shortcuts, just clear explanations so you can make informed decisions and avoid costly mistakes. And with that out of the way, let's get back to what makes this new deduction so different from anything you've dealt with before. For years, seniors have been used to one basic structure when it comes to taxes. You either take the standard deduction or you itemize your deductions. If you're 65 or older, you already get a small additional bump added to your standard deduction. And that's been part of the system for a long time. Many retirees assume that's the end of the story, but this new senior bonus deduction changes that framework entirely. And this is where people start underestimating its impact. This $6,000 deduction is completely separate from your standard deduction. It does not replace it. It does not force you to choose between options. It stacks on top of everything you already get. And that stacking effect is what turns this from a modest tax break into something that can genuinely reshape your tax bill. What makes this especially unusual is that it doesn't matter whether you itemize or not. Normally, tax deductions force you into one lane. If you itemize medical expenses, charitable contributions, or mortgage interest, you give up the standard deduction. If you take the standard deduction, you lose access to most itemized deductions. This new senior bonus doesn't care which route you take. Whether you itemize every possible expense or you take the standard deduction without listing a single receipt, this deduction still applies. That alone makes it one of the most flexible senior tax benefits introduced in decades. There's no complicated choice tree, no trade-off. If you qualify based on age and income, the deduction is available to you. To really understand why this matters, you have to look at actual numbers, not abstract percentages. Let's say you're a single filer who is 65 or older. In 2025, the standard deduction alone shields $15,150 of income from federal taxes. Because of your age, you also receive the existing age-based addition, which adds another $2,000. That part isn't new. What is new is that assuming your income is below the phase-out threshold, you now add an additional $6,000 on top of that. When you combine those three pieces, you're looking at roughly $23,750 of income that never even enters the federal tax calculation. That's not a loophole. That's not aggressive planning. That's the law. Now pause and think about what that means in real life. Many retirees live on a combination of Social Security and modest withdrawals from retirement accounts. If nearly $24,000 of that income is protected before taxes even begin, the difference can be dramatic. It can mean the difference between owing taxes and owing none. It can mean the difference between dipping deeper into savings and preserving what you've worked decades to build. This is exactly why misunderstanding this deduction is so costly. Seniors often assume their tax situation is fixed and predictable, when in reality, the single rule can shift the entire outcome of a return. And this is just the single filer scenario. The numbers become even more striking when you look at married couples, especially those trying to stretch retirement savings across 20 or 30 years. But before we go there, there's something important you need to understand, because this is where a lot of people make their first big mistake. They hear about a new deduction like this and assume it happens automatically, that the IRS will just apply it behind the scenes. That assumption alone is costing retirees real money. And in the next part, I'm going to explain exactly why that belief is wrong and what you need to do to make sure this benefit doesn't slip right past you. One of the most expensive assumptions seniors make with taxes is believing that new deductions happen automatically, that the IRS somehow knows you qualify and quietly applies the benefit for you. That is not how this works. The IRS does not hunt for ways to lower your tax bill. It only processes what you report. If this deduction is not properly claimed on your return, it does not exist as far as the IRS is concerned. And this is where a surprising number of retirees lose money. Not because the rule is complicated, but because they don't realize there's an extra step involved. The good news is that claiming this deduction isn't difficult, but you do have to be intentional. You must file using either Form 1040 or the Senior Specific Form 1040-SR, and you must correctly indicate that you're 65 or older. That simple checkbox triggers the calculation pathway that allows this deduction to apply. Miss it, rush through it, or rely on outdated assumptions, and the benefit never activates. This matters even more because this deduction is not something most seniors have ever seen before. For decades, the tax system trained retirees to think in a very narrow way. Standard deduction, plus maybe a small age bump, and that's it. So, when something new appears, many people don't even think to look for it. They assume nothing meaningful has changed, but something has changed, and it's significant. And unlike refundable credits that often phase in slowly or require special qualifications, this deduction directly reduces your taxable income, line by line. That makes accuracy critical. If you're using tax software, the calculations are handled for you, but only if the correct inputs are there. If you're working with a tax preparer, you need to make sure they are aware of this rule and not relying on last year's framework. This deduction is new, and new rules are exactly where mistakes happen most often. Now let's talk about the income limits, because this is where confusion really sets in. The senior bonus deduction does not disappear all at once. Instead, it phases out gradually once your income crosses certain thresholds. For single filers, that phase out begins at $75,000. For married couples filing jointly, it starts at $150,000. Above those levels, the deduction is reduced by $60 for every $1,000 of income above the threshold. That may sound minor at first, but over time it adds up. Eventually, if income reaches $175,000 for a single filer or $250,000 for a married couple, the deduction is gone entirely. No partial benefit, no fallback. It simply no longer applies. This structure is intentional. The deduction was designed to target low and middle income seniors who are more vulnerable to inflation, rising healthcare costs, and shrinking purchasing power. And from a planning standpoint, it means you need to know exactly where your income falls. Even if you're in the phase-out range, every dollar of deduction you can still claim matters. Partial deductions are still savings, and those savings compound when you consider that this rule applies for up to 4 consecutive tax years. Ignoring a partial benefit because it isn't the full amount is one of the most common and costly mistakes retirees make. There's another layer here that people often overlook. Modified adjusted gross income doesn't just include wages. It includes retirement account withdrawals, taxable investment income, business income, rental income, and certain other sources. That means decisions about when and how you draw income suddenly have tax consequences that didn't exist before. A slightly larger IRA withdrawal in 1 year could reduce your deduction more than expected. Spreading income differently across years could preserve thousands in deductions over the 4-year window. This is where timing becomes strategy. And this is why understanding the phase-out rules now before you file is so important. But before we go deeper into strategy, there's a major myth spreading online that needs to be cleared up immediately, because misunderstanding this part leads people to make very bad assumptions about Social Security taxes. And in the next section, I'm going to explain exactly what this deduction does and does not do when it comes to Social Security, so you don't get caught believing something that simply isn't true. There's a claim spreading fast online that this new deduction somehow eliminates taxes on Social Security benefits altogether. That claim is wrong, and believing it can lead people to make very costly decisions. This new senior bonus deduction does not erase Social Security taxes by itself. The rules around Social Security taxation have not changed. What has changed is how much of your overall income gets exposed to those rules. Under current law, Social Security becomes taxable once your combined income crosses certain thresholds. For single filers, that line starts at $25,000. For married couples filing jointly, it starts at $32,000. Combined income means your adjusted gross income plus half of your Social Security benefits. If you're above those levels, up to 85% of your Social Security can be subject to federal income tax. That framework still exists. What this deduction does is reduce your taxable income after those calculations, which can dramatically lower or even eliminate the tax you actually owe. Here's what that looks like in a real-world situation. Imagine a single retiree receiving the average Social Security benefit, roughly $24,000 per year. Under normal rules, a large portion of that benefit could be considered taxable. But when you apply the standard deduction, the age-based addition, and this new $6,000 senior bonus, the total amount of income protected from taxes can exceed the taxable portion of Social Security altogether. In that case, the result is little to no federal income tax owed, not because Social Security was magically made tax-free, but because deductions wiped out the taxable income before the tax bill ever materialized. That distinction matters because if you assume Social Security taxes are gone entirely, you might misjudge how additional income affects you. This becomes even more important when you're not living on Social Security alone. Many retirees have multiple income streams. Maybe you're pulling money from an IRA or a 401k. Maybe you receive dividends from investments. Maybe you still work part-time or collect rental income. All of that counts, and all of it feeds into your modified adjusted gross income, which determines both how much of your Social Security is taxable and how much of this new deduction you get to keep. To see how powerful this can be, consider a single senior receiving $40,000 in Social Security benefits and another $40,000 from retirement account withdrawals. Under the previous rules, that scenario could produce a federal tax bill of over $7,000. With the new senior bonus deduction applied correctly, that tax bill drops by more than $2,500. That's not a theoretical estimate. That's a direct result of how the deduction interacts with existing tax law. For married couples in similar situations, the savings can be even larger. And when you multiply those savings across 4 tax years, the impact becomes substantial. This is why timing matters so much. When income is flexible, like retirement account withdrawals, you suddenly have the ability to shape how much of this deduction you preserve. Accelerating some income into these 4 years might make sense in certain situations. Delaying other income until after the deduction expires might make sense in others. There is no one-size-fits-all answer, but there is one universal truth. Ignoring the interaction between income sources and this deduction is a mistake. Another critical point that doesn't get enough attention is that this deduction applies whether you are fully retired or still working. Being 65 or older is the requirement, not retirement status. If you're 67 and still earning wages, even part-time, this deduction can still apply as long as your income falls within the phase-out limits. That's especially important for people transitioning into retirement. Maybe you've cut back hours, but haven't fully stopped working. Maybe you delayed Social Security, but are still drawing wages. This deduction can provide meaningful relief during those in-between years when income is uneven and planning is hardest. And here's where a lot of people get nervous. They worry that claiming something new increases audit risk or invites scrutiny. That fear is understandable, but misplaced. This deduction is written into federal law. It's calculated using standard forms. And when claimed correctly, it doesn't raise red flags any more than claiming the standard deduction does. What actually increases risk is filing incorrectly, missing steps, or relying on assumptions instead of accurate information. In the next part, I'm going to walk through exactly how this deduction is claimed on your tax return, what forms are involved, and why the process is far simpler than most people expect. Now, let's talk about how this actually shows up on your tax return, because this is where anxiety creeps in for a lot of people. The idea of a new rule makes it sound complicated, but in practice, claiming this deduction is far more straightforward than most seniors expect. When you file your 2025 taxes in early 2026, you'll use either the standard Form 1040 or the senior-specific Form 1040 SR. Most people over 65 prefer the 1040 SR because it's designed with larger print, a clearer layout, and instructions that are easier to follow. When you complete the form, you indicate that you are 65 or older. That single step signals the IRS system to apply the age-based rules that follow. From there, the calculation of the senior bonus deduction flows through a separate worksheet designed specifically for additional deductions. In practical terms, you are not inventing anything, estimating anything, or justifying anything. You are following a set of instructions that already exist. There is a new schedule used to calculate this deduction, and it walks through the process methodically. First, it determines your modified adjusted gross income. Then, it applies the phase-out rules if your income exceeds the threshold. Finally, the eligible portion of the deduction is transferred to your main tax form, where it directly reduces your taxable income. If you use reputable tax software, this happens almost entirely behind the scenes as long as the correct information is entered. If you work with a tax professional, the process is equally routine provided they are aware of the rule and apply it correctly. This is why awareness matters so much. The deduction doesn't require expertise, but it does require attention. Overlooking it doesn't trigger a warning. The IRS doesn't send you a note asking if you meant to claim it. If it's missing, the system simply assumes you didn't qualify or didn't want it. What's reassuring is that this deduction doesn't require you to change how you live or how you manage your finances. There's no spending requirement, no special account, no documentation beyond what you already provide. It's a recognition written into law that seniors face a different financial reality than younger workers. And that brings us to why this deduction exists in the first place. Over the past several years, inflation has steadily eroded purchasing power for retirees. Healthcare costs have continued to rise. Prescription drugs remain expensive. Property taxes, insurance premiums, and everyday necessities have all gone up. Meanwhile, many seniors live on fixed or semi-fixed incomes that don't adjust quickly to economic pressure. This deduction is not a giveaway. It's an adjustment, one that acknowledges those realities and provides targeted relief where it's needed most. To understand the real-world impact, think in terms of tax brackets. A $6,000 deduction doesn't just reduce income on paper. It translates into actual tax savings. For someone in the 22% federal tax bracket, that deduction saves about $1,300 in taxes. That's $1,300 that can go toward prescriptions, medical co-pays, home repairs, or simply breathing room in a monthly budget. For married couples, the $12,000 deduction can double that impact. This is why the deduction feels different. It's not theoretical. It shows up in the form of money you don't have to send away. It's also important to see this deduction as part of a larger set of changes that came through in the same legislation. There were other provisions aimed at working Americans, such as deductions related to overtime income, tips, and certain vehicle-related expenses, but this senior bonus deduction stands out because of its flexibility and scale. It doesn't force you into a narrow category. It doesn't require itemizing, and it doesn't depend on specific spending behavior. It simply applies based on age and income. That makes it accessible to millions of retirees who might otherwise miss out on relief programs that are too complex or restrictive. The mistake many people make is treating this like just another tax tweak, something to glance at once a year and forget. But because this deduction only exists for a 4-year window, it deserves more attention than that. Each year you fail to claim it, or each year you structure income without considering it is a year of opportunity lost. And once the window closes, there is no way to go back and recapture what you missed. In the final stretch of this discussion, I want to talk about timing, planning ahead, and how to protect yourself, not just from overpaying taxes, but from scams, confusion, and last-minute pressure that causes people to make bad decisions when tax season arrives. One of the biggest mistakes retirees make with taxes isn't misunderstanding the rules, it's waiting too long to think about them. Tax season has a way of sneaking up on people, and when it does, decisions get rushed, papers get misplaced, questions go unanswered, and opportunities like this deduction quietly slip through the cracks. The reality is that your 2025 tax return is shaped by choices you make long before you ever sit down to file it. How much you withdraw from retirement accounts when you take income, whether you spread withdrawals across years or concentrate them, all of that affects whether you preserve or reduce this deduction. And because this benefit only exists for 4 years, timing matters more now than it has in a long time. This is not something to think about in April. This is something to think about now while you still have flexibility. If you work with a tax professional, the most important step you can take is a simple one. Make sure they are aware of this deduction and that they explicitly factor it into your planning. Do not assume they will automatically catch it. Many professionals rely on last year's frameworks unless something is clearly flagged. This rule is new, and new rules are where oversights happen. If you prepare your own taxes, give yourself time, read the instructions carefully, use updated software, and double-check that the age-related boxes and schedules are completed correctly. None of this requires advanced tax knowledge, but it does require attention. The cost of being overwhelmed or procrastinating is very real here. There's another risk that comes with new tax benefits, and it's one you should be especially cautious about. Whenever the government introduces a widely applicable deduction, scammers move fast. You may see ads, emails, or messages claiming they can help you unlock this deduction, fast-track your refund, or maximize your benefit for a fee. Some will imply the IRS requires special enrollment or approval. None of that is true. This deduction is written into federal law. There is no application. There is no sign up. There is no secret method. If someone is asking for money to access this benefit, that's a red flag. If someone pressures you with urgency or claims you'll lose the deduction unless you act through them, that's another red flag. The safest path is the simplest one. Rely on official IRS forms, reputable tax software, or a trusted professional, not strangers promising shortcuts. At its core, this deduction exists for a simple reason. Seniors have already paid their dues. They've worked, saved, contributed, and planned. And as retirement stretches longer and costs continue to rise, small adjustments in tax policy can make a meaningful difference. This is one of those adjustments. It won't solve every financial challenge. It won't eliminate uncertainty, but it does provide real relief, and relief that was specifically designed for people in this stage of life. Ignoring it doesn't make your situation simpler. It just makes it more expensive. So, here's the bottom line. If you are 65 or older and your income falls below the phase-out limits, this deduction applies to you. It is real, it is substantial, and it is temporary. You have 4 tax years to benefit from it, and every one of those years matters. Don't let confusion, assumptions, or procrastination decide your outcome for you. Take the time to understand how this rule works. Plan around it thoughtfully. Claim it correctly, because every dollar you don't send to the IRS is a dollar you keep working for you. Whether that means peace of mind, security, or simply a little more freedom in retirement, this opportunity exists now. Use it while you can. Use